everyone, and a very good evening. You're watching The Money Show on ET Now. I'm Ubina Kapasi. This is the show where we get you the latest when it comes to personal finance, ensure that you are on the right path to your long-term wealth creation journey, and of course even get you a gist of how you can spend your money wisely, because of course when we talk about money management, it's not about just investing and saving but also spending all of that hard-earned money. So here's what we have lined up for you on today's episode of the show. We are going to be talking about index funds, ETFs and active funds. Which one returns better? Which ones have higher expenses? Which ones should you buy? Who is suited for what is what we'll be discussing on the show. Later on the show, we'll be talking about life insurance. Max Life has a new India Protection Quotient Survey. This is their third one, and we'll be joined by the MD and CEO of Max Life Insurance, Mr. Prashant Tripathi, for more on that. Some positives, but also most Indians do not have sufficient life coverage. So how can you ensure you have sufficient life coverage? Stay tuned for that. And finally, in our Spend with TMS segment, we'll be talking about the big drop and the steep discounts by airline companies, which has caused airfare prices to fall. But there is also, of course, that extension of the ticket cap that the government has put in. And there are also still concerns around what are the restrictions around flying. So we'll be discussing all of that with Ajay Avtane of livefromalounge.com. So action-packed day on The Money Show today. But before we get to all of that, let's take a look at the headlines. Terrific Tuesday on the Lal Street as the Sensex is back above 49,000. Realty stocks roar. Strong earnings and vaccination hopes bring cheer back in the markets. Fuel prices are heading to the stratosphere. Petrol in Delhi hits a new all-time high. HPCL CMD MK Surana tells ET Now that price hikes are crucial for the government given the need to tackle the COVID crisis. That's an ET Now exclusive. Massive setback for WhatsApp. Government sources say that the Modi government has asked WhatsApp to withdraw its controversial privacy update and respect the privacy and data security of Indian users. The government is said to have written a stern letter to WhatsApp's CEO. Amazon India launches a startup accelerator program to help consumer brands access global markets. The entries for the startup accelerator opens today until the 7th of Feb 2021. Maharashtra resumes vaccination drive after it was put on hold amid glitches reported in the CoWIN app. This as the COVID count in the state witnesses a sharp decline. Nationwide too, fresh daily infections stand at a 7-month low. All right, those are the big headlines at this hour. Let's now introduce on the show Anant Ladha, founder of Invest Aaj For Kal. Anant, a pleasure having you with us today on The Money Show. To start with, let's talk about, this whole thing around active funds versus index funds versus ETFs. So vaguely, we do know that active funds actively managed by a fund manager, but how do index funds, ETFs differentiate? And of course, if we have to compare all three together, how do they essentially differentiate themselves?
Hi Mubina, thank you for having me on the show. Let me first start with mutual funds, and we'll distinguish between mutual fund versus index fund versus ETFs in the first part. Mutual fund is basically a pass-through vehicle which pools money on behalf of its investor and invests in a particular asset class. There is particularly 3 important points about mutual fund. Firstly, there is a fund manager which is deciding where to invest. Secondly, because there is a fund manager who is investing on behalf of investors, there is an expense ratio. And third, we can buy mutual funds from a mutual fund AMC, and it is bought on a closing NAV basis. This is mutual fund for us. Now, if we talk about index fund, just for ease, let us understand that index fund is also a type of mutual fund which invest in a particular index. Suppose, for example, there is a Nifty 50 index fund that will invest in a Nifty 50 basket. So as such, there is no active fund management involved in index fund because it is already decided where the investment will be going. And here also we'll be again buying it from the mutual fund house, the units of the index fund. Now finally comes the part of ETF, which is quite different than mutual funds and index funds. ETF, exchange traded fund. As the name suggests, we have to buy it from the exchange directly from the broker. We have to buy it. Mutual funds and index funds, we are buying from the mutual fund house. But ETFs will be buying from the BSE or NSE for that matter, directly from the exchange. We'll be buying it. For us to buy an index fund, there has to be a counterparty, just like we have it in shares. There has to be a seller if we want to buy it, and there has to be a buyer if we want to sell it. This is one important point which we have to understand when we are dealing in ETFs, especially because in India right now, volumes of ETF is not that humongous. We have to understand this. It is still a new concept and volumes are not that great. So while choosing an ETF, we have to ensure that we choose an ETF which has good volumes. But it doesn't mean that ETF is not good as a product. ETF is very good, especially for traders who want to time the market at a particular time. Suppose, for example, there is a sudden dip in the market. There's a 5% correction in particular index or maybe in particular sector, and I want to buy that fund at a particular time. For example, I want to buy it at 11 a.m. I can buy it only via ETF, but if I were to choose index fund or mutual fund, I can only buy it on closing NAV basis. So ETF is good for traders, and for a normal investor who want to invest for medium to long-term time horizon, he should use either index funds or mutual funds for that matter.
Okay. Understood. So ETFs can be bought anytime, anywhere, sold anytime, anywhere because they are traded on the exchanges. You cannot do the same thing with active funds or index funds that's essentially bought from a mutual fund house, a mutual fund distributor. Now, of course, the key point here will be, and by the way, index funds are essentially often called as passive funds as well. So I'm going to use these two terms interchangeably just to inform our viewers about that. So, what has been your analysis, Anant? Because at the end of the day, as an investor, I want to invest in a product that will give me good returns. So, what have you witnessed in the past in terms of performance of active funds and passive funds? And here, I would also like to put a disclaimer that past performance, of course, is no guarantee for future returns. But if you could just give us, share with us your thoughts on this point.
Absolutely right. It is a very valid point that we have to compare the past performance to understand that what we can actually expect from each of the product. For this, in our today's show, we are using SPEVA India scorecard. It is a data which is authorized data which is being published every 6 months. But there is two important shortfalls. Before going on to the data, we need to discuss about two important shortfalls which is always there with this data. Firstly, equal weight is given to all the funds. This is one important point. We have to understand this and we have to interpret it in a proper way. Equal weight is given to all the funds, even if a fund is a very small fund or maybe there is an underperforming fund. This data is giving equal weightage to all the funds. There are some funds which we as a distributor or maybe as an advisor or investors also remove on the first case only that at least in this fund I don't want to invest. This data is considering that fund data as well. First. Second important point is survivorship bias. Suppose there was a fund which was there 5 years back and now it is shut. This data will consider that fund as well while calculating returns so that the average returns is not biased because of survivorship thing. This is two important things which we have to consider. Right now, the data which I am referring to is the latest data which was published in October and it is containing data till 30th June 2020. If I talk about large cap, Indian equity large cap space in last 10 years, I feel 5 to 10 years data is more important as compared to the recent data. 10 years Indian equity large cap funds on an average have given 7.98% return versus the index has given 8.13% returns. This is one point which is very interesting. I know in large cap fund, even low performing large cap funds are being included, but there are still some good quality large cap funds also which have underperformed the index. This is one important point which data is telling us that the large cap fund overall have not been that great as compared to index. But when we compare to mid cap and small cap index, data is completely different. In last 10 years, mid cap data, Indian equity share market mid cap and small cap shares, on an average, mutual fund has given return of 10.2% returns versus index has delivered return of 7.12, means alpha of 3%, which is very good. Plus, if we consider and remove some of the not so good funds and some funds which are having some structural mistakes or some structural pointers because of which we usually avoid those funds, then this data suggests that we even have outperformance of more than 5 to 6%, especially in mid cap and small cap, large and mid cap and multi cap space. So here, a mutual fund surely is better than index fund. This we have to understand. I always believe there is space for both index fund as well as mutual funds, and we have to decide at which place we have to use which product. If I talk about large cap funds, last 10-year data suggests more than 67% of the funds have not outperformed index, which is a good enough data to suggest that instead of large cap funds, we can slowly start to move towards index funds. But the same data suggests that in mid cap and small cap category, more than 55% of the funds, and especially if we ignore some of the poor quality funds, more than 65% of the funds have outperformed the benchmark. All in all, for mid cap, small cap, large and mid cap and multi cap category, still mutual fund has its space, and mutual fund is a beautiful product. But if we are considering solely investing in large cap products, then we can consider investing in index fund as well.
Anand, just to follow up over there, do you recommend then that for those individuals who have large cap funds in their portfolio, actively managed, of course, large cap funds in their portfolio, do you recommend that they move all of it into index funds, or again, do you think that it should be a mix of the two?
I feel we can start with having a flavor of index fund in our portfolio, and eventually, as and when we are comfortable with index fund, we can move a larger chunk over there. And especially for investors, I personally feel multi-cap and large and mid-cap category is a very beautiful category. Even a large cap defensive investor can have some amount of allocation in these two categories. So we can have a mix of index fund plus large and mid-cap plus multi-cap category as a whole.
Okay, understood. All right. So let's understand the overall cost benefit analysis of active funds, because, Anand, here I want to bring the point of the fact that active funds, like you mentioned, because there's a manager and he's, going to be shuffling your portfolio, etc. There is going to be a manager fee charged by him or her. So if I have to overall look at the cost benefit analysis of a large cap fund, an index fund, and then of course a small cap and mid cap fund as well, because you had a different opinion on that. How would you essentially pitch each one with the other?
See, personally, I feel expense ratio of active fund in India right now is somewhere between 1.25% to maybe on a higher side 1.75% to 2%. An index fund, contrary, is charging around 30 bips, 30 bips to 70 bips. But expense ratio 1% should not be a point of worry to decide which product we should invest in. This is one important point. Also, if we were investing in a developed country, suppose if I want to invest in US market, I will surely prefer index fund, because opportunities of finding next multi-bagger stock in US market will be very difficult, because it's a developed market, it's a matured market, and it's a comparatively slow growing market. So for developed market, obviously index funds have a somewhat edge over mutual funds, but in developing countries like India, I personally feel mutual fund and having some alpha can give a beautiful returns in our portfolio. More than that, I'll just share an example. See, there is a rule, we cannot apply same rule everywhere. For example, in European countries or maybe in US, it is said that we should not consume too much of ghee and butter and oil for that matter. But in India, it is considered very healthy to have butter. So we cannot apply same thing everywhere. In the same way, I know 1% expense is extra in active funds, but if it can help us generate some extra returns, maybe around 3%, 4%, 5%, and in some cases, and in some small cap funds, even alpha of more than 5% is possible, which is humongous, and we should not miss this opportunity, at least in developing countries for that matter.
All right. Okay. So there you have it. That's some very interesting data points shared by Anant and his view on essentially how you can include index funds in your portfolio. He's given some analysis as well, a great analysis of how things have moved for index funds, active funds across different categories, large caps, mid caps, small caps. So maybe you could, reject things here and there, include introduce a portion of index funds in your portfolio if you don't have already. And now, for now, let's move on to our viewer queries. Folks, remember, you can always connect with us by writing in on The Money Show at etnow.tv. That's The Money Show at etnow.tv. Send in your portfolio to us. Any financial, money-related question that you may be having, send it in, and we will get it answered. So for now, let's take in some questions that we already have received. Shyamala Devi says, I'm a 55-year-old housewife and I've saved 30 lakh rupees from the income on my inherited agricultural land. Now she invested this 30 lakh rupees in 3 debt funds: ICICI Prudential Corporate Bond Fund, Axis Banking and PSU Debt Fund, and Axis Liquid Fund, all direct growth. And she's put 10 lakh rupees each in these 3 funds in Feb 2020. Furthermore, she started an STP as well of 10,000 rupees from Axis Liquid to Axis Growth Opportunities Fund for 75 months in March 2020. Time horizon is 8 months from now, and the purpose of her investment is for wealth creation. So I would presume that the other 2 debt funds are still with her, and she's just doing an STP from the Axis Liquid Fund. So she's 55 years old, and she doesn't really need the money right now. She can stay invested for 8 to 9 years. How do you think is the best way to split up this this windfall income that she has got of 30 lakh rupees, Anant?
Firstly, I feel very happy to see that this investor is giving equal importance to debt funds, which is very important. There is some slight changes which we can make according to me. Firstly, ICICI Pru Corporate Bond Fund has a YTM of 4.6 as on date. See, past in debt fund, we always have to see future returns and future expectations, and past returns we have to avoid. ICICI Pru Corporate Bond Fund in past has delivered good returns, but going forward, it is having YTM of 4.63%. And if I talk about Axis Banking and PSU Debt Fund, again, it has YTM, that is the rate of interest on which this debt fund has invested money, is 4.27%, which is quite less, which I personally feel. And looking at the time horizon, firstly, one important point which we can take care of is, instead of using such low YTM funds, we can shift to medium-term funds, which has duration risk almost equivalent. Paper quality is also good, and we can have some higher YTMs of maybe around 6.5 to 7% at least. Some examples can be ICICI Pru Medium Term Fund or maybe Kotak Medium Term Fund. This is one thing which we can change, and we can ensure some extra returns, some alpha in our portfolio. Second important point is, in equity, I am very happy to see that we have not done over diversification. We have chosen one fund. But just for the sake of diversification, we can introduce one more fund. I am not asking to introduce too many funds, but yes, one more fund which is comparatively defensive as compared to Axis Growth Opportunities Fund. See, Axis Growth Opportunity Fund is a fund which is having a P ratio of around 38 and a price to book value of 5, which is quite on a higher side. So see, firstly, large and mid-cap category is perfectly suiting her requirement. So we will be sticking to large and mid-cap category, but we can shift some amount, maybe 50% amount to a fund which is comparatively defensive and comparatively better valued as on date. Example of it can be DSP Equity Opportunity Fund, which has a P ratio today of 24 and price to book value of 2.3. Plus, this DSP Equity Opportunity Fund has a very different flavor of portfolio. It is heavy weighted in healthcare, construction, and technology, and versus Axis Fund is heavy weighted in financials, chemicals. So it will give us some diversification, and we can ensure that we are even investing in some fund which is fairly valued also as on date.
Okay. All right. So maybe introducing some funds will be a good idea, but I think the positive thing is that she's giving attention to, debt funds, and I think I think she started off on the right path. Okay, let's take on board our next question. We have Mayank Shah writing in saying that I have 3,90,000 rupees in the L&T Hybrid Equity Fund Growth Option and 76,000 rupees in the Motilal Oswal Multicap 35 Fund, again the growth option. So it's a total of 4,66,000 rupees that he's invested in these 2 funds. Now he's saying he may transfer this money to the following. Rather, he's asking, should he transfer this money of 4,66,000 to a few other equity funds in equal amounts for better returns? So the options he's put forward are Axis Focus 25 Fund, Invesco India Contra Fund, Canara Robeco Equity Diversified Fund, and SBI Magnum Multi-Cap Fund. Okay, so he wants to split up his 4,66,000 equally among these funds. So do you think, Anant, that's a good idea, or do you think he could perhaps even just hold on to the existing funds and maybe add on to these 4 funds? Because I'm sure your logic would be that, okay, maybe 2 mutual funds is not enough. Maybe you should add a few more. So what would you recommend, Mayank Shah?
See, firstly, best part about Mayank is he has already done his study, and he has already decided, and or at least have a frame in mind that what he want to do. First thing, I think what he should do right now is he should decide what his suitability is, and he should not ignore debt funds. He should decide a percentage of amount which you want to invest in equity, and separate percentage of amount which you want to invest in debt funds. This he should decide before deciding on to the funds. Second most important part is he want to exit from L&T hybrid equity fund. See, basically, I personally strongly believe that we should avoid using a hybrid fund, and we should allocate our amount directly into debt and equity. We should know that this is my risky money and this is my safe money. This we have to make sure from the very start. So he can obviously exit from L&T hybrid equity fund. But as far as Motilal Oswal 35 fund is concerned, this has underperformed recently, but overall it is a very good fund. See, I will not be investing more in this fund right now because size of this fund has crossed around 15,000 crores. But if I was having some existing investment in this fund, I would not recommend to redeem it just because it has underperformed for some period of time. This is one important point. And of the funds which he is sharing us, one of the best fund which he has chosen is SBI Multi-Cap Fund. It is basically a very good fund because it's an analyst fund. They what SBI has done in this fund, they have 6 separate analysts who are tracking 6 different sectors and who are investing in 6 different parts, and they are having 0 sector risk. Every fund has 2 type of risk. First risk is sector risk, second is selection risk. In this fund, they have reduced sector risk as equal to 0. They are exactly copying their benchmark as far as sector is considered, but they are taking selection risk in which fund, in which stock they want to invest, and which stock they want to avoid. So this is one important and good point about SBI Magnum Multi-Cap Fund. If I talk about Axis Fund, which is Focus Fund, Axis Focus 25 Fund, this fund again size is personally an issue, and I will suggest that we have some better funds in this category, and we should not invest just by looking at past returns. It has delivered super good returns in recent part, but recency bias should not have impact on our present decision, and we can avoid this fund. As far as Invesco India Contra Fund is concerned, it is a very different theme of fund. It's a value fund, which is a very good fund, and even he can consider ICICI Pru India Opportunity Fund, looking at his suitability. And if you want to actually invest in a fund which is fairly valued, India Opportunity Fund can also give him a flavor. And Canara Equity Diversified Fund also is a good fund. I feel he has selected a lot of funds. He's already having Motilal Oswal Multi-Cap 35 Fund. He can add 2 more equity fund. One he can have from large and mid-cap category, and another he can add from multi-cap category, and one he can have a debt fund. And these 4 funds will suffice his purpose. And this is something which you have to see according to his suitability, what is suiting him. For example, focus fund is an aggressive fund comparatively. Is aggressiveness suiting his profile? He has to make sure this point.
All right, well, there you have it. That's your questions and queries answered. Anand, thank you so much for joining us today on The Money Show and, helping our viewers out with the concepts as well of index funds, ETFs, active funds, and understanding up until now what's it been like, and, maybe giving us a glimpse of how our portfolios as well could look like with these funds.
Thank you so much for
And remember, folks, as I always say, you can catch this entire episode on ET Now's YouTube channel, and not to forget, always stay connected with us by writing in on The Money Show at etnow.tv. And for now, we'll do one thing. We'll take a very short break right here on the show. But when we return, we will be joined by the MD and CEO of Max Life Insurance, Prashant Tripathi, to talk about the key highlights of their new India Protection Quotient. Well, let me give you a teaser. A majority of Indians believe that they are underinsured when it comes to life insurance. We'll be back after a short break.